Hey guys, welcome to my channel Solid Trades. Ali here. Alright, so today is going to be a very, I think probably my most important video that I'm going to be putting out on YouTube is how to have smaller losses and big winners. Basically, the golden rules of risk management in day trading. That is what I do on the daily basis, and it is the most important aspect of trading. Without this, you cannot be successful. And I have learned from the top traders, the $1,000,000 traders, what they do, and if implemented it, I've had amazing results. And that is what I'm going to be showing you today, exactly what needs to be done. So if you're one of those people who are having bigger losers, you make $100, $100, and then lose $500, and then it wipes up all your gains, this is the video to watch. Must watch till the end. I'll promise you this will be one of the most important video you will ever see in day trading if you are not having consistent winners and small losers and not big winners. Okay, so let's get into it. So what would you learn in this risk management? There are three keys, three important part or the pillars of risk management. Okay, the number one is systematic trading plan. You have to have a systematic trading plan. A systematic trading plan means a strategy that you're going to be implementing in your trading. Okay, and then in that trading, the systematic trading plan, you need to have a proper risk to reward. A proper risk to reward strategy. And the third is the appropriate position sizing. So I'm gonna go through and actually detail out each part so you understand what each means. And then once I'm done with it, I'm gonna show you a real example of how to execute this all together, how to put everything into practice. Okay, so let's get started. So the first is you must have a systematic strategy. Basically, a systematic strategy, what it does is that it doesn't have you don't buy and sell and feeling on emotions. You buy and sell based on what you have a plan, what your strategy tells you. Okay, so this is very simple, straightforward. Also, it lets you to think less and do more. When you see your strategy, you just execute, right? So if you think less, you already know what you're going to do if it presents itself. And that strategy includes that you have a plan, and a complete plan means that you have an entry where you're going to enter the stock, where you're going to exit the stock, so that means that what your stop loss will be, and where once you're entered in the stock, where you're going to take profits. Okay, all of these things you need to know before you enter the trade. So you need to know your entry, you need to know your exit, and then you need to know potential targets to take profit. Okay, and the whole goal for this systematic strategy is to remove emotions out of the picture, so you can plan and plan the trade so you can trade actually the plan, right? If you know exactly what you're going to do before you enter the trade, so you just put it in action and then just let it do its thing. And if it hits your target, it's your target, you make money. If it hits your stop loss, it hits your stop loss and you lose money and you move on. Okay, and by doing that, having a systematic strategy, what it does is basically you're putting odds in your favor, right? So basically, a systematic strategy means that it has a higher probability of success. So you're basically putting yourself in a higher probability. So for example, this is a chart, and if you have a strategy, let's say that you buy on support and sell in resistance. So you're going to be buying at support areas. You're going to buy here, and you stop loss if it breaks below. So if your stop loss will be if it breaks below, and then you sell, and your target will be if it come close to resistance, right? So that's the strategy. A strategy is a buy. Simple strategy would be to buy a support and sell a resistance. So you buy a support, your stop would be below, and your sell will be up here. Okay, so that includes your entry, your exit stop loss, and your potential profit target. So that's basically a strategy that includes all of these aspects. Okay, so now that you have a strategy, you need to have a risk to reward. And when I talk about risk to reward, basically what that means is that a winning percentage is not important. If you're making trades 90% of the time correctly, you can still manage to lose money. Okay, for example, if you make $100 in 10 trades, so you make 900, and then in one trade you lose 2,000. That means you're going to be end up negative 1,100 for the day, right? So even though you write 90% of the time, you can still lose money. So it's very important that you have a proper risk to reward in every trade. Okay, so a winning strategy, if you have a winning strategy, it was designed to have a big winner and small losers. So even if you write 50% of the time, you'll still end up making money. Okay, for example, 10 trades on a 90% win system. So 9 trades with 10 winners, that's equal to, and 1 loser, that's equal to $10 loss. Okay, that's not profitable even with the 90%. But with 10 trades on a 40% win rate system means 4 trades with 80 winners and 6 trades with $20 losers. You still end up making money with 200 because with 4 trades of 80 winners, you make 320. And if you lose 6 times, but you lose less, okay, that's the key. You lose less, you end up still being profitable even with just a 40% win rate. Okay, and I'm going to show you exactly how it needs to be done, and that's the key. That is the key. All the big traders, they're right. A good trader, a very, very good trader, is right about 60 to 70% of the time. Okay, that's it. They are wrong too, but when they're right, they have a bigger winner, and when they're wrong, they have a small loser. Okay, and I'm going to show you exactly how it needs to be done. Okay. So risk reward, basically, when you talk about risk reward, so you need to have a smaller loss and bigger win. And if you just, in simple words, basically you need to make sure you cut your losing trades fast when you're wrong, okay, and let your winning trades run the longest. And it's because it's a game of probabilities, right? If you have bigger winners and smaller losers, you're going to end up being profitable, even though if you're right only 30% of the time, right? So so now here in this table, you see, let's say that if you're having 1-to-1 risk to reward. Okay, so 1-to-1 risk to reward means that if you're right 50% of the time, you will just break even. So that means that if you're making $100 on each winning trade and then losing $100 in each winning trade, in each losing trade, and you're right only 50% of the time, you will break even. But with 60, you will end up making money. However, if your risk to reward is 2-to-1, which means that if you're making 200 in every winning trade, but then losing only 100 if you're in your losing trade, even if you're right 30% of the time, you'll still end up making money. So you see how risk to reward plays a huge role. So even if you write only 30, so let's say if you trade terribly and you're only right 30%, but when you're right, you make 200, and when you're wrong, so you only lose 100. You just cut your loss quick and you let your winners ride. You don't have to be profitable 50 or 60% even. But the cool thing is that, the longer you trade, the better you get, the better your win rate gets. So imagine having a 60% win rate with 2-to-1 risk to reward, right? And that's all you need. You don't have to be 90% profitable, okay? And this is something, a very, very tough thing for people to take, because everybody wants to be right 100% of the time, right? But you have to change your mindset. It's okay to be right only 60% of the time. It's okay to be right even only 40% or 50% of the time. It's okay. If you're wrong, it's totally okay. And if you realize that if you're wrong and it's okay, then you will be able to cut your losses quick, okay? Because you will not be stubborn. So when you're wrong, realizing that you're wrong and accept the defeat and move on is one of the most important part in trading. And that's why, like, if you think about it, market doesn't ask you what's your win rate, right? Let's say if you go to the bank and you make money, right? Let's say I'm right 60% of the time and you're right 90% of the time, okay? Yet I make more money, for example, because I'm taking 3-to-1 and you're taking 1-to-1, right? We both go to the bank, I'm gonna have more money. The bank is not gonna ask, it's not say, oh, you had 90% win rate, so you should get more, and I had 50% win rate, so I should get less. No, whoever makes the more money wins, right? So it doesn't matter what the percentage is, okay? So you have to just ingrain in your mind, all right? Now that you understand the risk to reward, Now, how the next part is position sizing. It's the most important part. The reason why position sizing is so important is that you always position yourself to lose. For example, if you're risking, I'm taking $100 as just a whole number example to make it easy. How do you make sure that you lose when you're wrong? You lose $100 every single time. And when you're right, you make $200 or more every single time. Do you see what I'm saying? So that's where the position sizing comes in. If you position yourself correctly, you will always have the same loss amount every single time. This is the most important part. If you want to take anything from the video, this is the most important part. Let's get into it. So once you have a proper trading system and understand the risk to reward, you now have to focus on position sizing, and you need to know how much you're going to lose before you get into a trade. Okay, so let's say we're taking $100 in this example. So for example, if you're risking $100 and your risk to reward is 1, 2, 3, you will make 300. Then you should only buy enough shares so that if it hits your stop loss, you end up being wrong and you only lose $100. Okay, so you need to calculate your shares based on the stop loss, and that goes to the lesson number 1, is that you need to know your stops before you enter into a trade. So if you know what is your stop before entering a trade, you can calculate your shares, okay, and then only buy enough shares so if it hits your stop loss, you only lose $100. Okay, now $100 is just just a basic, just a very easy number for me to just give you an example. But how do you know if you are but let's say that $100 is too much for you, okay, or $100 is too little for you. Like, okay, I don't care about $100. I want to make, I can lose, even if I lose 50 or $500, then I'm okay with that. So everybody is different, right? And people ask, okay, how much should I start with? It's up to you. It's based upon your financial situation. Okay, if you into a trade and you're not okay to lose $100, then you shouldn't put $100. You should put less than $100. And the tip is that the tip is that when you're in a trade, okay, and your heart starts to pump like tuck 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 tuck, it means you're too much size in it. Okay, because if it goes against you, you're gonna get really emotional. So if you feel that whenever into a trade and you feel that pump, hard pump feeling, it means you have too much size. So you need to cut it. You need to reduce your risk. Okay, you need to reduce your risk to the point where you're not emotional anymore, and that's the right size. And then from there you build on it. Just like going to the gym, when you first go to the gym, you can only lift 150 pounds. Okay, so you start with like 20, right? And then once you're okay to lift 20 for like a week, then you go like 25. Then after a month you're like, okay, now 25 is easy, now you go 30. Similarly with that, so you're risking 100 and you're okay with that. But if you risk 150, that's too much for you. So 100 is the one for you, and then you risk increase to 120, 130, 140 over time, and you eventually reach to 1,000. Okay, even more than that. Okay, so that's how you realize. All right, so position sizing, that's why it is the most important part. Immediately stop if you're buying set numbers of share every single time and revalue it. Okay, if you buy like 200 shares every time you enter into a trade, okay, regardless of what your stop loss is, do not do that, because then your losses will be way haphazard. Okay, so for example, 100 shares with a stop loss of $20. Okay, if you buy 100 shares but your stop loss is $20, you're going to end up losing 2,000 if you're wrong. And 100 shares with a stop loss of $1, you're going to lose $100 only, right? So in both the cases, you bought 100 shares, but depends what your stop loss is. It could very hugely have a huge difference in your losses. Both the cases you bought 100 shares, but depending on your stop loss, your losses are so much significant different, right? So share needs to be calculated based on a stop loss. So here's how you do it. So stop loss of $1 with 100 shares will give you a result of $100 loss, and stop loss of 1,000 shares with 10 cents loss will also result in $100 loss. So if your stop loss is $1 and you risk $100, then you can buy 100 shares. But if your loss is 10 cents, then you can buy 1,000 shares, and you're still going to end up losing $100, right? Guys, this is gem. If you guys, by the way, guys, if you haven't subscribed it, please subscribe. I'm going to be putting out some gem information out there, and you don't want to miss it. All right. And by the way, there's a link down below if you want to join a Discord chat where I post lessons every single day. We go through live trades. Okay, so make sure you join. All right. So in a nutshell, risk management is where first what do you need to do? Okay, first start trading small, learn yourself and learn your system, make your strategy. Okay, then once you are consistent, increase your size by 10% every winning week. So let's say you were losing $100 and you're okay with it now. Next week you don't go and you start risking 300 or 400. Start with 110, increase 10%. And then once you're comfortable with that, then 120, 140, 160. Okay, so that way if you're wrong, you don't end up losing huge amount because you're okay losing 100. Next time if you do lose 110, it's not a huge difference. Okay, so risking 100, then risk 110 and 25 and so on. Okay, and sky is the limit. Once you get consistent, guys, then sky's the limit. Imagine you're risking 5,000 per trade and you're right, you make 15,000. Exact same process, right? It's just that the size is going to be different. That's all. So if you consistently make 100 a day, then nothing is stopping you to make 1,000 a day. All you have to do is increase your share size once you're comfortable with it. Okay, so now we understand we talked about this whole strategy of risk management. Now we're going to try to implement it, okay, in a trade. So here I have, if you don't have, you don't understand the strategy of support resistance, watch other videos. I'll post in the link below as well. But I talk about this, so I'm not going to go into detail, but I'm going to here I'm just going to go through real quick. The strategy is that you buy at the break of this trend. Okay, so this is the horizontal resistance and this is the vertical resistance. The strategy is if it breaks above, this is a good area to buy and your stop loss will be below. So as soon as you buy at the break of trend line. So right now this price is $36.50. Okay, so what you do is that if you buy at $36.50, how many shares should you buy so that if it hits $36, which is your stop loss, which is the below of this support, you lose $100. So you're going to buy 200 shares, okay, with 50-cent stop loss. So now you know if it does go below you already know you're going to lose $100. That's it. You're not going to be able to lose more than that, all right, because you buy 200 shares, all right. And then if you're risking, let's say that you're risking 1, 2, 3, you're risking $100 to make 300. 1, 2, 3 is the reward. So that way you only have to be right only 40% of the time to make money. Okay. So you're gonna sell here at $1.50, right? $1.50 profit. 50 cents loss, $1.50, which is 1, 2, 3. So you're gonna sell here. So before you entered, right, when you entered here, you knew your stop loss was here and you knew you're going to take profit here too. So you don't even have to worry about anything. As soon as you buy, you put your stop, you put your limit, and you just go do your work. If it hits, you're going to make 1, 2, 3. Okay? And that's it. So basically what we did, we had a systematic trend strategy. We knew our risk before entering a trade, which was $100. Our risk to rewards was 1, 2, 3. We did proper position sizing of 200 shares because if you were wrong, we're going to lose $100. So we positioned that position. We did not buy 400. Okay, you cannot buy 400 and expect to lose 100 only, right? If you're buying 400, then you're going to lose 200. If you're not okay to lose 200, then you shouldn't buy 400 shares. You only buy 200 shares. Okay, and then once you're comfortable with it, get better and better, and you're okay with losing 100, you can increase your share size. Okay, now imagine if you were risking $500, then you would buy 1,000 shares, and that's equal to 1,500 profit. Exact same thing. You buy here, sell here, exact same thing, but the profit is now 1,500 in a trade, right? So sky is the limit, and that's what I'm talking about. That way you will always have consistent losers, small losers, and big winners every single time. Okay, and you will never be emotional, and that's the most important part. All right, guys, so this is it. This is the end of the video. I hope you enjoy and hope you learn. This is the most important part in trading. If you are not doing this, please stop trading and reevaluate. Okay, and definitely look into this more. I have lots of videos on it. Please go check out my channel. And if you have any questions, please post it in the link below. Join our Discord chat if you want. Yeah.